warm welcome to our channel Talk of Town. This is a brand new series which we have named as Beyond Boundaries, where we're going to discuss a lot of topics which are relevant today. In this episode, we're going to touch upon an important domain which is personal finance. To discuss this, I have two subject matter experts with me here, Mr. Prabhanjan, who is a SEBI registered investment advisor, an equity expert handling a lot of NRI clients based out of UAE and Africa. Warm welcome to you, sir.
Thank you so much.
We also have with me Mr. Ashwin Kumar, the executive director of DAA Capital, who has been into the equity markets for slightly over 2 decades now. Welcome, Ashwin.
Thanks, Ellen. Hi, Prabhanjan.
Hi, Ashwin. Nice talking to all of you today.
Absolutely.
Especially the markets are green. It always gives us a good thing to talk.
Absolutely. I was about to say that.
Absolutely. So, warm welcome to all the viewers as well. In this episode, it's we are brimming with joy because after a streak of volatile weeks, volatile months, we are seeing markets in green for at least a few days now. I believe it's because of the kind of rally we have seen over the last 3 to 4 years. Do you think, Mr. Prabhanjan, that people have forgotten that markets can correct? Why is there so much of hue and cry?
First of all, very thank you for calling me on this platform. To me, the reason why the markets are pretty volatile. Volatility is the nature of the markets. That's where we need to go and digest, right? So the hue and cry, what we are seeing these days, is only because of the media noise. We take out the media noise and take out the new investors who are called we call them as a COVID investors who have started investing after the COVID. They have not seen this falls. See, for us, I think I'm pretty sure we all have seen 2008 fall, 2013 fall, 2019-20, and this is the fourth. I don't call this as a fall at all. This is just a mild correction. And also, the volatility is very, very normal to me. And second thing is, the US markets, if we see, US is, of course, the mother of all markets. It has been rallying despite Trump tantrums. And every inflation data, every job data is coming in favor of it. Whether it comes in favor of the US or not, the markets are continuously rallying. And of late, we have seen some disturbances in the US market. But if we compare the global markets with the Indian scenario, I personally see what we see at Elysian is the markets is down because of there was some overvaluation that kicked in the markets. Before the global rally, we rallied too fast. Before the global markets followed, we have fizzled out. You see the Nifty, it is down 10-15%. The small index, the mid cap index, they have done more than 20-25% at an index level. And see the portfolios, they have gone down 30-40%. So we always say to our elite clients at Elysian is market volatility is the nature of the markets and stay invested. So staying invested is one thing, is the big mantra. And see all the legends, if you see, they made money only when the markets have fallen. Right. So we have to stay invested during these markets. And this is a very short-term view to me, is the valuations are pretty high. And then valuations will kick in. How will that kick in? Because of the valuations, there is a lag in the corporate earnings. When there is a lag in the corporate earnings, the base becomes lower. So when in the next league, we are tackling with a lower base, and even a small 10% increase looks like a big percentage. So that advantage we always have it. The second reason we always see why the markets are in this turmoil mode is the currency depreciation. And in fact, 3 to 4% was a sudden sharp in the currency depreciation in the last 2 or 3 months. What we have seen,
and we have never seen the talk of the town.
Exactly. And we have never seen such a steep fall in the currency depreciation. So, and the third one is we are going through a phase of time and price correction. So that is in fact good for the markets. And during the phase of time and price correction, there would be a lot of rebalancing of the portfolios that happens. We also are advising our clients, like on the rebalancing. We sit with them and then rebalance. So that's what we are doing, and we are also asking them to do a profit booking. So profit booking, time and price corrections are very eminent in any market, and then during this market correction, that becomes more important. And of course, the US market impact, the Trump tantrums, import of the inflation. And one good thing, what I also see, is he's strengthening US balance sheet. Whether we like it or not, Trump said he's a businessman. He doesn't care emotions. So for him, it's a US economy, US balance sheet. So I feel in a long run, when the entire markets are in sync with the US markets, we will start the game again. But with at that time, we will start with more rigor, more energy, and more money flowing. So I think that's where I feel the US market, for temporary correction, what we are seeing is a good opportunity where we need to tap this. And of course, the FII selling, and we all know FII selling. I mean, in the short term, the supply of money is out, the stocks fall. So that is where we also see a lot of market correction that is happening. And the last but not the least is the crude oil prices.
Right.
If we see the crude oil prices, it is like, Trump always comes and say, drill, baby, drill. So when he has that famous Nara, then it has a global impact on the oil prices. And similarly, even the UAE is also, the OPEC also has started, rejigging their output production, the prices. So these things can also have a significant impact. And the China factor, I also mentioned the corporate earnings lag. So these are the reasons why we see a significant market correction. Though it has come little early, it is good for us. So as a long-term investors, I always feel we have to stay invested in the market, and big money is made only when you stay invested, and it is only applicable to a patient investor.
All right. I mean, it was interesting the number of times you took Mr. Trump's name. I only wish he's watching our podcast. Moving on, Ashwin. So, I mean, always we retort to the famous, taglines and the seasoned investors say, right? People say, you need to be greedy when others are fearful. It is easier said than done. So, considering the markets where we are today, what's your outlook for the Indian markets, at least for the short term?
Thanks, Ellen. I mean, I wish you guys the very best. I believe this is the first episode of Beyond Boundaries, and I'm glad to be a part of it. So, wishing you guys the very best. I second what Prabhanjan just said. See, he covered all the fundamental aspects of it. It's not just domestic, but also the global factors. But to add to what Prabhanjan said, see, we all know as fund managers or even as retail investors or as an independent investor, somewhere in the back of our mind, we knew that the valuations that the market was quoting back in August and September of 2024 was not really sustainable. See, we all knew it. And let's not act surprised. Please don't get me wrong or take me as an arrogant person here, but we all knew that it was not sustainable and the correction was imminent. Right. Somewhere, I think at that point in time, logic took a backseat and emotion kind of took over, and we all were in that raging bull market sort of scenario wherein, I mean, see, the last 4 years have been extravagant. So somebody who was invested 8-10 years back, who saw that very single-digit returns between 2015 and 2020, it all made up for them. But the bottom line is the valuations or the kind of steep up move we saw between December of 2023 and August and the late 2024 September was not really sustainable. 15%, 15.46 or 15.84% correction in the Nifty index is absolutely acceptable. Even from a technical point of view, bare minimum is 23.6% if you have to take the Fibonacci grid or go technical here, but 15% is okay. But the surprise element came from the mid cap and small cap and the kind of fall certain stocks have seen. They've been, butchered 30, 40, even 50% from the top, and some big names. You talk about certain sectors which was where people were, all of us were going gung-ho about, probably say defense or railway sectors have been beaten down 40-50%. And somewhere I strongly believe that the mean or the prices have to come back to their standard numbers, and it has. Now the next point that comes here is the natural emotion for all of us was to see that V-shaped recovery. People have started using the V shape, the U shape, the W shape, and none of us honestly know it. I think the kind of fall that we saw, more than the fall, people were, if you see 8 to 10 years back, a lot of investors have become very patient, very smart in terms of spreading their purchases over a period of time, not really going at one shot. But what happened was every level, every support, every technical level got breached. And at some point in time, people got exhausted of buying. And of course, usually the bigger market players tend to spoil the party or shake you out with a massive sell-off in the last leg. And the last 5-10 days has been really good for the markets as we speak. But the most important thing for us to understand is that we may not have a V-shaped recovery. See, V-shaped recovery happens once in a decade, not every time. And markets are never are never a kind place wherein you put your money and you take out an X percentage. It does not work that way. I think the good phase of the market has probably ended or is about to end. The next leg of the up move, which I'm very confident of will happen over the next 3 to 5 years, will not be a smooth up move. It will be only a few handful of stocks that will move the market. There will come a scenario wherein the broader markets are up, but your portfolio is down. Why? Because you do not have the right set of stocks. So for me personally, as a fund manager, I would be very keen and interested in selecting the right set of stocks to ride the next up move. See, none of us are contesting whether there is going to be an up move or not. Probably, if we were having this session 10 or 15 days back, even we would have been down on our emotions. Right. But the last 10 trading sessions have been really good for the markets, and we are being positive. And also one information or one action that we took as fund managers back in 2024 or September, to be precise, September 2024 and October 2024 was we started booking profits. We were okay moving the money from equity to either hybrid or debt funds, and for an aggressive investor, we were even able to move the money into gold and silver. And you've seen over the last 5 to 6 months, gold and silver have appreciated more than 10%, and we were able to enter. We looked at it as a natural hedge, also as a short-term opportunity, and we did that. And now, slowly, if I have to be, give you an inside view, slowly we have come out of equity and gold by a substantial margin, and the money has been moved to equity, either direct equity or through the mutual fund route on a STP basis, which is kind of a systematic transfer plan. So we are not very aggressive in buying, but yet we are buying into the market as and when we saw a dip. So now we are quite bullish on the markets, but we still have some cash left with us to deploy in case there is an unanticipated correction that is happening in the market.
Okay. In fact, I wanted to specifically ask Mr. Rao, you've been dealing with a lot of investors across the globe and advising them in the right way. So we could typically have 3 category of investors as of today. So A category could be people who have already invested all their investable surplus into the markets.
Right.
What should be their strategy? B, there could be investors who already invested, but they do have some surplus today. What should their strategy should be? And last but not least, there could be small investors who wish to invest on a systematic basis month on month. So if you can throw light on the strategy for all the 3 segments of investors, it could be of great help.
Great. So in fact, we started a lot of my high net worth clients. They started calling when the markets were falling. They were not panic, but I mean, when they are investing in that scale and size, they do understand the financial markets. And then we are also very constantly keep educating them that during the risk profiling process, being a SEBI registered investment advisors, that's one of the job that we actively undertake is to educate our clients. Right from the day they invest, we tell them stock market returns are never linear. So there would be only 15 or 16 sessions in an year where you will see the up move. So which are those 15 and 16 sessions? Nobody knows. So what is the mantra? Stay invested. So this is what I always keep saying to those investors who already has invested. And I understand now the portfolios are done by more than 20-30%, and even my personal portfolio is done by 40%. But still, as per the risk profile, we have invested and we reach out to all of our clients, and then we try to see if there is any rebalance that is required. So rebalancing during this portion is during this phase is the key. Why we say rebalancing is the key? Because this gives an opportunity for us to pick the quality stocks and shun out the stocks which we already made money, shun out the stocks which the PEs are much higher, and also understand the stocks where the growth story is not intact. At the time of investing, there might be some models where they would not be on the right track. So we sort of we evaluate those business models in terms of management and a lot of other things. And then if that growth prospects is not up to the mark as we envisage during the time of investing, so the PE ratio will definitely fall. So how will the stock price increase? There are two ways. One is the EPS increase and another one is a PE expansion. So when the PE is already expanded, so we identify those stocks and then say, yes, we made our money, so let's rebalance our portfolio. That's a thing which we always do, and I always suggest for the people who have already remained invested. And the second is the averaging. So those guys have to average it out. And I understand there's something called capital rationing. We need to do it. So capital rationing, when we say, we call it as a portfolio rationing. So what we exactly do in that is we match that with the tax efficiencies of the particular individual clients, and then say, let us sell this particular stock at a loss, and then take the tax advantage, and then we rebalance. Portfolio rationing, we do that. Second is, if there are some clients where they do have some money left in their kitty, and we also advise all our investors that always remain invested. 10 to 20% you should remain in cash, that is in liquid assets. That's our strategy. So that this is the time where we see exponential growth. This is the time where we can deploy the 10 to 20% after the rebalancing, so that we average on the portfolios.
That means, do you also recommend that this is the time they can go all out on equity and have very limited debt in the portfolio?
I think this is what you said is very right. So we are recommending to all our clients that concentrate and build a long-term portfolio. To me, the definition of the long-term is not 3 years, is not 5 years. To me, it is beyond 7 years. So once you have that appetite to remain in the market for 7+ years, that is where long wealth can be made. These cycles, over a period of years, when we have analyzed, these cycles come and go in a period of 3 to 4 years. So if we are there for 7 years, that means we have seen 2 cycles. So that is where we can make big money, and this fall also gives us an opportunity to identify those stocks where the PE ratios are very high, the stocks which are very highly overvalued. So it gives us to take out those stocks and then bring in some other stocks and we also concentrate more on the secular growth sectors. So majority of our portfolio is based on the secular growth, so that any political disturbances or any other economic disturbances won't impact these stocks. Even if they impact, then they are the first ones to recover when the markets recover. So to you, and what was the third question?
If there's an investor who invests in a staggered approach,
right.
What should be the strategy?
So for the third set of investors who wants to invest in a staggered manner, I think they should stick to their SIP way and then identify the stocks. And I also, over the period of years, my experience is we believe in creating concentrated portfolios, and also it would be the same advice to the staggered investors, the small investors as well, to identify concentrated portfolio, not more than 7 to 8 stocks, and then keep doing an SIP. Just keep doing an SIP, and do it for 7+ years, not even 5 years. And that is where we believe that's the key to go. And then constantly rebalance whenever it is required.
Excellent, excellent. So, coming to you, Ashwin, so Prabhanjan ji mentioned on the importance of portfolio rebalancing. So, a very, very connected topic is the asset allocation. So, during these, times when the markets are down, how will your asset allocation change? Would you be ultra aggressive, or you would stick to your original asset allocation? What is it you would advise your clients?
A good question. See, I am a person who likes to stick to the discipline or the table or the plan that we have in place when we started out. But you always have that 20% room for tactical adjustments. You cannot be so rigid that I'm not going to change it at all. Certain tactical adjustments have to be done based on the market conditions without deviating too much from your asset allocation, from your risk tolerance, or even your long-term goals. But certain portfolio rejigs have to be taken. See, when we kind of saw that the market is about to peak out, we were kind of calling out a market peak out. Let's say 25k Nifty. I cannot pinpoint and say this is going to be the top or this is going to be the bottom. I believe that's a card that the market holds very close to its chest, and we can only speculate, but we cannot really make a accurate call there. You can always, suddenly, and when you move the money out, the idea was to kind of move the money to debt. But suddenly you saw an opportunity in gold and silver. Does it mean that I move all the, let's say I came out of 40% of direct equity and it was lying in liquid funds? Would I move my entire 40% to gold or silver? No, I just go client-wise or just look at the risk tolerance and maybe take a small or a calculated 10 to 15% bet. And try to encash on the opportunity, because at any point in time, Lakshmi, I'm clear about one thing. We are walking a random walk theory. None of us know. Every time it's a 50-50 probability.
Right.
None of us know what exactly is going to happen. If it goes as per our plans, fantastic. Let's all celebrate. But if it goes against you, it should not put me out of the market or take me to a place wherein I have to completely exit the market. So that is one thing I'm very conscious, not just in the client's portfolio because we have a responsibility there. Even in my personal portfolio, I'm not very aggressive in terms of let's make a major shift. So I like to stick to the plan. When we drop an asset allocation based on the risk tolerance and goal, it's very clear that, see, we've been in the market reasonably long enough to understand the kind of surprises the market can throw.
Yeah.
And we need to be prepared for it, and most importantly, keep the client prepared for such scenarios. Like Prabhanjan just said, that we too started receiving calls, but because we were able to communicate to the client that there is a impending correction happening, and we kind of moved the money to debt. Most of the questions were, I would say, 7 out of 10. People started calling because they saw an opportunity here. Could we be more aggressive? Could we be redeem our FDs or move all our debt instrument to this? But we were like, no, let's not do it. Let's stick to the plan. And other 3 questions were predominantly like, should we look at rebalancing? This is the time we have a particular fund has underperformed. And I am a very big believer of rebalancing or tactical adjustments, because see, you always need to be, or you rather need to understand and try and be one step ahead of the market, although it may not happen every time. Because I tend to believe that the stocks that fall the least during a corrective phase are usually the leaders of the next bull market.
Right.
So for me, the last 6 to 7 months has been a time to review our portfolio, be it mutual funds or be it direct equity investments, and clean up all these stocks which have underperformed. Maybe because there is a fundamental shift in the company, or maybe because of excessive correction which the stock should not have done, and try and move the money to stocks which you possibly think are going to be the next leaders of the next bull market. So sticking to the asset allocation, sticking to the plan with the tactical adjustment in place, I think that should serve the purpose. And every time there is a correction, it does not call for any action. If somebody is a ultra long-term investor, I think they could just either not even look at. We've had clients who say, look, I just look at the portfolio once in a year. I don't even worry about it. I just look at it during the tax filing season. What happens in between does not really bother me. Or then you have opportunistic investors who are like, look, if there is a correction, let me know. I want to move some money into equity. But apart from that, you should, every correction or every fall in the market should not draw any action from you. Sometimes doing nothing also, does the best for your portfolio.
Exactly.
In fact, since you mentioned about tax filing, I have a quick question to Mr. Prabhanjan. So, a lot of us as investors more often than not, take investment decision based on taxability. What's your take on it?
I think investments and taxability go hand in hand. They go hand in glove. What I would say is, if you are a tax efficient investor, then you might not make your losses good, but at least you can reduce your incidence of taxes.
Right.
Like, for example, there is a client of mine where we have reviewed the portfolio in the month of, last 15 days, and then we have advised them. There are certain stocks where they are doing a lot of losses. And since we also know the personal, the income tax, what they pay, then we said, let's go and then redeem this. Let's go and sell it. So that long-term capital, let's make it as we also need to understand whether the gain or a loss is a short-term capital gain or a long-term capital gain or losses. Because accordingly, we will be in a position, or the client also should be in a position to understand that, and accordingly invest, redeem, and make their strategies. As I said, the losses we cannot make good the losses, but at least the incidence of tax you can reduce it. And long-term capital losses we can carry forward for a period of 8 years. That's one of the big tool where when we know the business, as Ashwin rightly mentioned, when the stock is not performing for a longer period of time, during this juncture, it always makes sense for us to take a call on it, book losses, carry forward for 8 years, and again adjust this against the long-term capital gain. So when you see this as a business model, that's why whenever we deal with a client, we always tell them 7 years is the minimum stock-in period. You assume that 7 years is your business case. This is your business case. You are in the business for 7 years. Don't get out of it. And that is where you can make real strategies. When I say strategies, every strategy should follow the law of land. Every strategy should talk to the tax efficient. To the tax. The prevailing taxes. That is where you can maximize your gain.
Excellent, sir. Excellent.
Sorry that I've been moving around little on this, away from the screen. So we are, shooting this during the live market hours. So I am not as long as an investor like Prabhanjan, but because market is on, so I just got a little distracted to see what the Nifty is quoting it right now. Sorry about that.
No worries. So we all are stock market enthusiasts. We do understand. Even though my blood is boiling to look at my thing, so I'm just getting afraid of Mr. Allen, what he will tell me. So
don't be surprised if he has another screen on, which is actually showing the markets for now. Yes, sorry, Lakshmi, go ahead.
Interesting points, actually. So, like it is said, two things which can never be avoided is death and taxes. So, let us all declare what we earn, and as much as possible, plan your taxes in the right way. It's the season of your tax loss harvesting. We are in the fag end of March, so right time to reach out to your financial planners, work on it. Interesting discussion today. We covered a lot of important aspects. The investors who would be watching this episode, would have very, very good takeaways on the markets, on asset allocation, on portfolio rebalancing, and how you should be looking at tactical adjustments. Last but not the least, planning your taxes as far as your investments are concerned. Thank you, gentlemen, for being with us on this episode. We'll be back to you soon with an interesting topic very soon. Thank you.
And I hope that there is markets would have moved higher during our next call. So
Fingers crossed.
Yes,
fingers crossed and amen.
Thanks, Lakshmi. Thanks, Prabhanjan, for connecting. It was good talking to you guys.
Great. Thanks, Lakshmi, and thanks, Ashwin. It was a wonderful meeting all of you.
Yes.
See you. Bye bye. Cheers.